The buzz around pre-IPO stocks or unlisted shares, as they are popularly called, is going up. Investors are getting attracted to unlisted shares basically on the hope of earning multi-bagger returns on listing. The new age investor who uses the services of a lot of startups or Indian unicorns is eagerly waiting to invest in shares of companies like PayTm, Zomato, Flipkart, etc. These new age investors are not thrilled by the prospects of mature companies that have been around for decades. Even some of the experienced investors have realized that by the time startups mature and get listed, their valuation has peaked and there is no juice left for the retail investor. So, should you really consider investing in these pre IPO or unlisted shares? Unlisted shares are basically shares of companies that are not listed on the stock exchanges. Startups issue ESOPs to their employees, and these employees might be looking to sell their shares for liquidity. Some of the older well-known names of conglomerates are also available in the unlisted space, and investors consider investing in these names for dividends or prospects of future listing. However, there are several pitfalls around investing in unlisted shares that makes it a bad idea for the retail investor. Our purpose is not to discourage you from making investments in these securities, but to make you aware of the risks. Lack of liquidity. Listed shares are traded on the stock exchange and the price is determined by the demand and supply. You can get in and out of any stock within a few seconds. However, for the unlisted shares, there is no liquidity in the market. It is like an over-the-counter negotiation between the buyer and the seller. There are no reliable sources of information on the market price of the unlisted share. The buy price and the sell price of these shares sometimes have a gap of more than 10%. Some websites will sell you the shares at rupees 100, but they will buy it from you at rupees 80 or 85, just like the Forex guys at the airport. Low chances of listing. Not all startups out there in the market will survive. Forget going public. Most of them are loss-making companies which rely on several rounds of fundings from the PEs and the VCs. For every one success story, you will have several other failures. While you can exit from bad investments in the listed space just within a few seconds or by a few clicks of your mouse, in the unlisted space, you will have a tough time finding a buyer to these shares. Unregulated. Though these shares are stored in your demat account, the regulations around unlisted shares are minimal at this moment. You transfer the money into the bank account of a third party, then there is a lot of paperwork to take the delivery of the shares into your demat account. And there have been many instances where a buyer has transferred the funds to the third party and he or she never got the shares. Difficulty in buying and selling. The process is cumbersome, but even more cumbersome is the negotiation. You have to literally bargain with the buyers or sellers to come to an agreeable price. Also, since there is a massive FOMO or the fear of missing out in this space, investors sometimes don't even study the basics of the business before investing. If at all the company does hit the stock exchange through an IPO, you will have to wait for 1 year after listing before you can sell your shares. Yes, there is a lock-in. While it is tempting to add fancy names to your portfolio and you do get the high out of owning shares, which are the next big thing, the risks are high and so is the probability of losing a large chunk of your capital. New investors and retail investors in general should get their basic portfolio in place before venturing into the unlisted shares. First, get a term cover, start an SIP, put money in provident funds, and have a solid long-term strategy in place. Your initial investments definitely shouldn't go into this space. However, in the long run, if you are interested, you can have a small allocation to unlisted shares as a part of the broader portfolio strategy with a limited allocation.